We have Danielle DiMartino Booth, CEO and Chief Strategist of QI Research, to break down the Fed's recent FOMC for May meeting and the decision to hold rates steady. Danielle, I refer to you as the Queen of the Fed, so welcome. So great to get your perspectives. Tell us what went on this week. What did the Fed decide to do?
The Fed decided to go back to being a dual mandate institution. That, to me, was the most interesting thing. Jay Powell at the podium said for the last several years, we've been more focused on inflation than on our employment mandate. I mean, I was really surprised he actually said these things because the Fed is legally obligated to follow both of its mandates, not pick and choose. But he said, we're going to go back to following employment just as closely, basically. And the markets interpreted that, and rightly so, as being dovish.
So tell us what the policy implication from that perspective was, Danielle. Talk to us about what the decision was in terms of the headline rates. And then let's also talk about the Fed balance sheet, because that's something you've been talking about for quite a long time that doesn't grab the headlines in the same way.
It doesn't, but that certainly was a newsmaker yesterday. I think what we have to bear in mind is how very important the Fed's balance sheet is to shaping policy. The Fed has not been able to hit its $35 billion per month bogey for its mortgage-backed securities quantitative tightening since June of 2022. We've been at this for almost 2 years because so many Americans have the golden handcuffs of a 2.5% or 3% mortgage rate. So they're not prepaying their mortgage. They're not refinancing. So prepayment speeds have come down so much that, as Powell mentioned at the podium, they've been closer to $15 billion a month. And so I think that you have to focus on that. I started with that because even though they're going to reduce the pace of Treasury roll-off from $60 billion a month to $25 billion a month, that was about $5 billion lower than what market participants were expecting. What he's saying is we're going to keep going on the mortgage-backed security side. We're going to play catch-up, and we're not going to necessarily shorten the duration of quantitative tightening, which right now is anticipated to go through the end of 2025. So markets are seeing this as very, very, very much kind of an injection of liquidity, of easing. But to Powell's point, he wants to make sure the money market funds don't force another not QE episode that we saw in 2019. So for functionality, he's going in this direction. But again, he's not closing the door to the shrinking of the Fed's balance sheet lasting through the entirety of 2025.
And what about the rate outlook, Danielle, in that context? Reading between the lines, what did you hear Jay Powell say would be the next rate action?
So it was pretty fascinating to listen to Powell yesterday reference Indeed.com job openings. He referenced the Conference Board, their measures of households' perceptions of whether jobs are hard to get or not. That was really a slap in the face to the official payrolls data, to the weekly jobless claims data. It was really kind of a moment of it was very unorthodox. It was heresy for the Fed chair to go there. But what he's trying to say is other indicators of the labor market are weakening. So even if what we see on non-farm payroll Friday is not disastrous, we're hearing from other areas of the economy that people are very skittish about their prospects if they do lose their job. What does that tell us? It tells us that there's no rate hike any longer that can be presumed in 2024. In fact, I think Powell squarely put rate cuts back on the table, 2, if not 3 this year, whereas markets had really whittled it down to 1, if not none.
And in terms of the areas of inflation that seem to be the stickiest, Danielle, unpack for us which areas and drivers of inflation are concerning the Fed the most right now.
Well, they're concerning the Fed, but for different reasons. They're concerning the Fed because the Fed cannot control the cost of automobile insurance when 14% of the drivers have no insurance on the roads of America, and they're driving up the prices for the rest of those who are insured. The Fed can't control the cost of healthcare, food, the price at the gasoline pump. And these are the things I think that Powell, the pragmatist, realizes. And because when you start to try to control the uncontrollables with monetary policy, that's when you end up using a very blunt tool. And you end up going down the road of quote unquote pushing on a string because you're trying to control something you cannot control. What can the Fed control by staying higher for longer? The cost to buy a car, to finance a vehicle, the cost to finance the purchase of a new home. Those are the things that we've already seen some dissipating demand for, meaning the Fed's higher for longer campaign for inflationary sources that it can control has indeed been efficacious.
And what about the timing for rate cuts, Danielle? As you said, the expectations of the market have changed really quite dramatically from sort of this time last year. And one of the things that has been often in the conversation is the time it takes for rate hikes to make its way through the system to start having impact or to have the control that you're talking about for the Fed to see its impact. What about going in the other direction? If the Fed were to cut rates, would that mechanism be faster than the one that we've seen for rate hikes?
So I would say the answer is only if they were to cut rates more dramatically than they increased rates. That's the only thing that's going to speed up the lag effect. My greatest concern is that if the unemployment rate crosses the 4.0% threshold, which puts the Fed into an easing mode, into a cutting rate stance, that let's call it a quarter of a percentage point of easing, it's really not going to have any appreciable effect for some time. You have to really get the momentum and you have to get a sufficient amount of rate cuts for that to begin to trickle through in 12 or 18 months.
So it's background. This focus on the labor market, again, the dual mandate language, Danielle, that kicked in a lot more strongly yesterday. Let's talk a little bit more about where you think unemployment goes. You follow the job market. You and I have had really interesting conversations about indicators like trucking and logistical data that you follow. What are you looking at that's a little unorthodox as lead indicators of where employment levels might go as we get through this year?
So I've actually really become fond of the layoff announcement data produced by a fairly young firm called Macro Edge. And what I like about their methodology is that it's very specific. They're very detailed. Such and such laid off 270 people today. It's not just Tesla laying off 14,000. They're tracking on a very granular level public layoff announcements that have shown that in a seasonally benign period in the spring, when normally we would not see a lot of layoffs being announced in the month of April just kicked January right out of the park. 115,000 layoffs were announced last month. That compares to 104,000 in the month of January. It's kind of like what we're seeing with existing home inventories rising very fast in a time of the year that you don't normally see that during peaks being spring selling season. So, I think right now, if you want to know where unemployment is going, you follow the money, or the money that companies are no longer spending on employees who are no longer on the payrolls.
And Danielle, it's a last minute macro thought for you, but talk to us a little bit too about the GDP data we've been seeing coming out in the first 4 months of this year. Where are you now on recession outlook?
So I think that that on the recession outlook, we have to bear in mind that it took 15 months for the Bureau of Economic Analysis to determine that the first quarter of 2008 was indeed a negative print. What helped them make that determination with such a long lag, knowing that, oh my gosh, we thought we were expanding, but we're actually contracting? What helped them was revisions that are timelier to the payrolls data. So I bring this up because we learned that rather than 640,000 jobs created in the third quarter of 2023, with benchmark revisions, that actually ended up being negative 192,000, a loss of 192,000 jobs in the quarter ended September the 30th. So my call that recession will have started in October is starting to look much sounder based on revisions that are coming in once the statisticians in Washington, D.C. are no longer extrapolating using models, the data, but rather getting hard figures from employers.
So based on that, Danielle, if you're correct and we started to see that softening in the fall of 2023, when do you think the data comes in blaring sirens saying, that's it, we're in the downturn?
It's interesting you asked that, Anne, because in the case of 2008, which I will look back to, it really wasn't until the third and fourth quarter when, by the way, Lehman Brothers collapsed. I mean, by then we knew the world was on fire, but it wasn't until then that we actually started to see the initial negative prints in GDP. It wasn't until revisions much later that we knew that the actual recession had started at the beginning of the year. So it was in the thick of what we thought was Armageddon when Lehman Brothers was collapsing. That was when we first started seeing negative GDP prints, when it was much, much, much too late.
When I follow your calendar there, Danielle, and sort of apply it to where we are now, sounds like by the time we're in full throttle election season, things could be getting a little interesting on the data front when I map that through.
They will be. I think if this administration can push off until after the election, revealing any bad data, I think they're going to try their level best. And that puts the impetus on investors to really be doing their own homework so they're not sideswiped when the actual data hit with revisions and lags.
Danielle DiMartino Booth, every Fed meeting is your Super Bowl, and you're so good at coming back and unpacking it for us. Thank you. Come back soon to Public Live. That's it, folks, for us on Leading Indicator.